After the close, we'll get those announcements, Brian. Some big payouts expected from the big banks on Wall Street. Brian, do you want to stick with the banks? I've got the bank sector right now on the S&P 500 up 27% year to date. That's through the first half. What will the second half bring?
So I'm more confident that interest rates are going to be higher by the end of the year than I am that the oil price is going to be higher. So if I'm choosing between financials and energy to play the cyclicals trade, I'd still rather be with the banks. The trouble is, and we have a whole section devoted to this in the mid-year, is the 10-year has really become this puzzle. I think it's been accentuated after the FOMC meeting. We basically have it, moving down because the expectations are now that the Fed tightens too quickly, too early. They won't have to tighten by as much, so rates stay lower. It's going to be hard for investors to continue to puzzle this out. We still are pretty confident that by the end of this year, we're going to be higher on the 10-year. The economy will still be doing well, be probably as well as expected, not better than expected at this point. But that will still mean that we can see rates kind of rolling forward to that eventual liftoff and pushing up. And that should be fine for the banks, especially in this I think, overall very strong global growth environment.
But Brian, from your standpoint, the capital return plans alone don't get it done. You need the bond market to come with you.
It's been so correlated to the 10-year, the relative performance. It's hard to escape from that trade, really, in any sector. I mean, we have the very high dividend sectors have been kind of negatively leveraged to the 10-year in many ways. Financials are going to be positively leveraged. And one thing we caution investors about is if we do get some kind of taper-related tantrum, some kind of Fed policy error that's worse than the one that we had 2 weeks ago, there's not that many things that do well in a portfolio in that environment. You could have your bond portfolio selling off, credit should do fine, but in the equity market, the financials would probably be the best game in town in that kind of environment. So if you're looking to hedge against that particular kind of risk, this is not a bad way to do it.
So Stu, from your perspective, are we all bond market strategists now?
I think we've all been bond market strategists for 6 or 12 months, John. I think we just didn't know it, unfortunately. And I'm equally bad at that as I am at volatility, so it really hasn't changed my career trajectory at all. But look, we are, our view both technically and from a fundamental perspective is you're going to get higher yields in the U.S. As I mentioned, the mix shift is different, and for that reason, it actually makes us more buyers of banks than we otherwise would have been. I think coming into the FOMC, we liked, metals and mining, we liked energy. Banks was in the mix, probably more of a second half trade. What the FOMC did is it kind of pulled that forward, and we like being long those financials, especially in earnings.